All right, good morning, everyone. I hope everyone had a wonderful evening last night kicking off our conference. My name is Stephen Rose. I head up the debt platform for Community Bank of Texas on the affordable housing side. We're a $3 billion Houston bank, certainly active in this market. Know a number of faces out here, but if I get an opportunity to meet up with you over the next couple of days, that would be certainly our pleasure, as we're quite active. We are proud to be here this morning to introduce, to sponsor the breakfast event, as well as introduce Dr. Robert Dietz. Dr. Dietz is Chief Economist, Senior Vice President for Economic and Housing Policy for the National Association of Home Builders, and certainly done a number of research throughout the years. He brings great experience and value add to us from the taxation for tax credits. Specifically on the national level, he has testified before the House Ways and Means Committee as well as the Senate Finance Committee, and then more specifically to our world, the Senate Banking Subcommittee, specific to housing and economic issues that we're facing today in America. Without further ado, I'd like to introduce Dr. Dietz.
Great, thank you. Thank you very much. Just to say thank you to Christy and everyone else for inviting me here. So Dave Crow was the prior NAHB chief economist. He wrapped up a 28-year career at NAHB. It's 8:30 Eastern time, so I kind of imagine he's probably sitting on a Virginia mountainside in his retirement house. And but I'm very happy to sort of kind of step in his shoes, big shoes to fill. Today, what I want to do is take a look at where we think the macro economy is, look at what's being built, and in part answer a question, particularly on the single family side, why don't we see more construction than we do? I think there's a general agreement, particularly again on the for sale side, that inventory is really tight. So Economics 101 would suggest builders should be building a lot more, and we don't necessarily see that. So answer that question on the single family side, and then look at the multifamily side, some of the demographics, what's being built, and maybe ask the question, are we building the right kind of multifamily housing for the medium term? So without further ado, we'll kind of get started. Got to start with GDP. You know, the economy's been decelerating over the last 4 quarters. Now, you don't want to be too negative about this. You know, we're not predicting a recession in the near term, although over the medium term, probability is rising. We're now in the 3rd longest expansionary cycle, or I'm sorry, 4th longest since the Civil War. So at some point, a recession will happen. But what we're seeing right now in the short term is this kind of deceleration. You can see it in the red bars. The first quarter, only 1.1% GDP growth. In part, that's because housing is underperforming. But the other thing is that we're seeing consumer spending slow down. And we saw some weakness in business investment, particularly as the oil and gas boom ebbed, as oil and gas prices fell. But it was consumers that were really kind of propping up the economy. You saw expansions in things like credit card debt, a lot of expansion in auto purchases. Well, over the last 4 quarters, we're starting to see that slow down. And the reason that that's concerning is that we've got lower oil prices. Now, I said help or harm here. The help is that we know that lower oil prices, down by 30% in terms of gas prices, that acts like a tax cut for consumers. So that should be freeing them up to spend money on other items. The harm here, the reduction in oil prices certainly has had an impact on GDP because we've seen lower investment. But on net, it should be a help, and the fact that we see consumer spending slowing is a bit of an issue. This is net lending standards. You can kind of think of this as where we are in terms of business lending. I'll kind of direct your eyes to the purple line on the bottom. That's commercial and industrial loans. And you can see it's been in tightening territory, negative numbers, for the last 3 quarters. And we expect that to continue based on what we're seeing in the data for the 2nd quarter. What we're seeing there is twofold. One, development loans for oil and gas have gotten a lot harder to get. That makes sense. The other factor is we are seeing tightening conditions for multifamily lending. So that's going to be something important I'm going to mention when we get to the multifamily forecast. We don't see it yet on the single family side or the land development side, but it's worth watching as we go forward. Of course, everybody knows that the Federal Reserve finally made its first move at the end of 2015. At the start of 2016, I think a lot of economists were predicting we'd see 3 Fed hikes this year. We had forecasted 2, and I think now we're effectively down in the sort of the wake of Brexit to just 1. And it's a question of will we see it in the fall or will we see it in December? So the Federal Reserve's long-term plan to normalize monetary policy, which everyone sort of agrees has to happen, is going to happen a lot more slowly than everyone expected. And that's a consistent theme with the recovery cycle that we're in. Everything is just moving in slow motion. It doesn't feel like growth. It is, but the same is true for the Federal Reserve. And their concern, I mentioned the probability of a recession over the medium term is rising. You know, they're sort of in the situation where they only have 1 bullet left. And raising rates, even though it'll have a short-term economic dampening effect, the question is, what can policymakers do if we go into a recession? Given that rates right now are virtually 0 anyway, fiscal policy is relatively loose. The one thing is regulatory policy is tight. If you can think of the 3 levers that we use to regulate the economy, and I'll mention regulatory issues here in a second. So without being too negative, we do think the prospects for building growth are really quite positive. One is that despite the unevenness that we've seen in GDP growth, the employment market's actually done pretty well. As a result of the Great Recession, we fell from 138.4 million jobs in the economy to just around 129 million. It represented a 6% decline from peak. That black line is sort of the trend level. And you can see right now, we're about 104% in the peak level, so we've surpassed the prior payroll employment peak, but we're still not quite to trend. And that is a bit of an issue because we have the unemployment rate right now at 4.9%. So we have a diminishing labor pool. The economy has been producing jobs, and that's been good news for multifamily production in particular. The question, though, is where are we going to get that additional job growth going forward when immigration's slow and we've got a long-term decline in the labor force participation rate? I mentioned the connection with multifamily. This is actually in economics, it's not physics. This is a pretty tight correlation between 2 variables. So we've got the blue line is multifamily permits and the red line is employment. And there's a really strong quarterly connection between multifamily activity and job growth for the economy. So if we do see a bit of a slowdown in job creation, and we have seen that over the last 2 months of data that we've got, the average has gone from, say over the last year, it was about 220,000 jobs being created. Now it's down to about 150,000. So what impact will that have on multifamily production going forward? The other issue is that job connection is strongly connected to the fundamental driver of demand for housing, demand for home building, and that's household formations. And I always like to say I like this graph because it kind of really shows where we've been and I think where we're going in terms of housing demand. So prior to the recession, we were averaging about 1.4 million net households being created for the United States economy, and 12% of that was renters. The recession happens and that falls from 1.4 million to about 500,000, and 130% of those were renters. As I always say, okay, what does it mean to have more than 100% growth in renters? Well, the count of homeowners is actually falling. So all the growth in net households in the nation is due to the rental side and making up for the difference in the decline in homeowners. We've had a bit of a rebound over the last 4 years. This is kind of a noisy data set. You can kind of see those 4 quarters. We had a surge. We're still not quite sure what happened there. I don't think the Census Bureau knows what they measure here. But when we average it out over a few years, yeah, we've seen an increase in household formations to about 1 million. It's still the case that we have some declines in the count of homeowners. So all that growth is rental growth. But that's good news, and that's part of the reason that we're seeing those gains for apartment development in particular. Now, there is an issue, everybody kind of knows it, that has millennials or friends with them. The rate at which Generation Y is living with home is significantly higher than what we even saw a decade and a half ago. You can kind of take a look at the red line, that's age 25 to 34. That's the years in which people should be or historically have been forming independent households. And you can see in 2000, this is some data work that we've done at NAHB, about 12% of people in that age class lived with their parents. In 2014, which was the last time we were able to do this analysis, that had gone up to 21%. And when we look at some other data that's more recent, we can't put the numbers out yet, we think it's continued to rise, probably 22 or 23% today. There's a lot of discussion. What is this? Is it a cyclical event? In other words, is it an echo of the Great Recession and poor employment markets, high student loans? Is it structural? It just reflects a change in preferences. This generation compared to, say, Generation X is just more likely to live at home for a longer period of time. Or in the more extreme case, you can think of it like Japan. When we think about the demographics, Japan is not a place that we want to emulate or go to. Low population growth rate, low marriage rates. You've got, I would like to say that it seems like a lot of Japanese men in their 30s would rather play video games than get married. So this is a bad situation. The term with Japan is that it's becoming a nursing home without enough staff. They don't have immigration, they have an aging population, and they don't have a lot of marriage rates. So that rise in living with parents could be a good thing in the short run, in the sense of pay down debt, student loans. But over the long run, if it stays like this, this is a real challenge to household formations going forward. The other thing to think about is where we're getting the growth in the renter households. You can see in 2011, that blue box at the bottom, that's essentially Generation X. So in 2011, they were the largest component of the additional growth that we saw in renter households. In 2014 and 2015, it's changed to that light blue box at the top. That's 65 and older. So in other words, one of the growth segments that we're seeing right now in the rental house market is baby boomers. And that's connected then back to that living at home. So we are getting rental growth. When I go out on the road and I talk to people doing seniors housing, East Coast, other places, it is a growth market. We're not seeing this in all data sets. In fact, one of the trends that was forecasted for this period was a downsizing of baby boomers. I don't think we're seeing a lot of that, sort of empty nesters going into downtown areas. But when you look at this kind of household data, you do see that's where some of the growth in the rental households is coming from. And then, of course, the long run declines in the home ownership rate that we think will end over the next 2 to 3 years. The red bars, kind of where I am here in Generation X, they're the ones that really have been hit the hardest in the declines of the home ownership rate. You can see in 1990, 35 to 44-year-olds, about 66% home ownership rate. 2015, it's less than 59%. So that's the demographic that's really changed compared to, say, 2 decades ago. We do think it'll even out over the next few years. There are plenty of economists who think we're wrong. The Brookings Institution, a really good think tank in DC, really sharp, smart economists, they think we're in for 2 decades of home ownership declines. Kind of a slow, almost like an evaporation. I think they're wrong, because when I look at the consumer preference data, I think people want to become homeowners, but they are going to be renters for a longer period of time. And to a certain extent that helps the labor market, that can be a good thing. I always put this up here because I sound like I'm throwing doom and gloom at you. But when we think about the prospects for building growth in particular, but also home resales and rental growth, we're really kind of actually in a really favorable demographic spot. The horizontal axis is age, the vertical axis is count of people. The yellow box is basically kind of roughly age 26 to 35. That's where headship rates really spike. So this is the key ages when people form independent households. Mostly renters, but some homeowners. And you can see where we've been in terms of born 67 and 1980. That's Gen X. That 3.8 million, that's kind of where people I went to high school with. There weren't a whole lot of them. So it's not a big surprise that we saw a dip in building production during that period. Because when they went through that yellow box, there were just a slackening of housing demand. That 4.7 million, that's the peak of the millennials. And as they move through the system, this is sort of undergirds our forecast. We see strong, maybe not the growth rates that we've seen, but strong continuing demand for multifamily production and accelerating demand for single family as that group ages. Now, if you're going to look for the seeds of the next housing crisis, kind of maybe look down there at the 5-year-olds and younger. there's a bit of a dip. Now, it's kind of a negative decline and then it drops again. That is the echo effect of the Great Recession. We've had 4 years of the lowest birth rates on record since the Great Depression. We had a slackening of immigration, so we have fewer households. So fewer households having fewer babies, the result is that we're going to have a bit of a dip in the population. So if you're looking out and making land use decisions or housing demand decisions and think, okay, what's going to happen 15 years from now? You know, there is a bit of some trouble there, or at least a changing of what home construction would look like. More fixing up older housing, energy efficiency, maybe a little bit of a slackening on the production side. Like I said, the sort of the theme right now, I think that dominates the overall housing market is low inventory. This is for sale inventory, but I think it gives you a good sense of what's going on. The red line is from the realtors. The number of existing home sales, basically for sale, has basically been flat. We're getting growth in the blue line, which is new construction inventory, but it's not rising fast enough to prevent the growth in prices. So then the question is why? You know, economics would say we should be seeing more building growth. We've seen it on the multifamily side, but have we seen it on the single family side? And I've called these constraints the 3 L's. So it's the constraints are lots, labor, and lending. And this is from a kind of a technical, geeky economics side, is a different way of doing a forecasting model. Traditionally, over the last 3 decades, if you were going to forecast home building activity, you looked at the demographics, you looked at income, job creation, and you didn't really sort of think that much about the industry's infrastructure. And today, it's the supply side that's really the constraining factor in meeting the demand that is out there. And so that's where those lots, labor, and lending come from. They're the primary inputs on the supply side, the business side, and they are determining how fast the industry can grow. So one, labor. Ask anybody in the building industry right now if they're having trouble finding workers, and the answer is yes. Labor markets are tight for recruiting, for subcontractors, for transportation sector, energy sector, even with some of the slackening of activity, the labor markets have been tight. This is from the Bureau of Labor Statistics. It's the JOLTS data set. This is Chairman or Chairwoman Yellen's favorite data set at the Federal Reserve in terms of what she looks at in the labor market. It measures job openings. In other words, open, unfilled jobs that are being advertised that can't be filled. The red line is sort of the smooth measure. And you can see right now we're looking at an open rate in the construction sector that's roughly equivalent to what we saw in 2006, despite the fact that the construction industry is not producing anywhere near as much activity. So we've got a really high rate, and the trend is growing, of unfilled construction sector jobs. This always kind of amuses me because every few weeks I get a call from a journalist who wants to think that we're making this up for policy reasons, advocacy reasons. There it is. We have a construction sector labor shortage situation. Very clear in the data. The other thing is that the labor force for the construction sector is aging. The median age of someone who is in the occupation of construction, so no sales, no finance, no owners and administrators, but just people swinging hammers, is 42 years old. And you can see in certain parts of the country, particularly the Northeast, it's up near 45. So this is an industry that's going to have to rebuild its infrastructure, and this is an area where NAHB can play a pretty active role, because it's going to have to be a nationwide effort. We have a sister organization called the Home Builders Institute that's going to have to play an important role, as well as the local associations. We have to recruit the next generation of construction workers. That's the medium-term challenge. Well, again, Economics 101, if we have a shortage of something, we expect the price to go up. The blue bars are residential construction wage growth over the last few years. The red is wage growth for the overall economy. No surprise, since 2012, we've seen residential construction wages growing faster than the overall economy. And of course, those costs are going to embed themselves in rents and for sale prices as those input prices increase. And then nationwide, you can kind of see the distribution. Texas, North Carolina, places where wages are rising fastest. That makes sense, because where the activity. And then our NAHB chair this year is from Illinois. Illinois is not seeing a lot of residential construction wage growth. They actually have some of the worst performing building markets nationwide. All right, so that's labor, lots, We currently have 64% of builders telling us that lot supplies are low or very low. So that represents another constraint on building activity, and I think that applies for single family as well as multifamily. Third L, lending. On the single family side, this is acquisition, development, and construction loans. The survey measures actually multifamily and single family. The solid line is an NAHB quarterly survey. Positive measures here represent tightening lending conditions. You can kind of see 2010, 2011. This is a period in time when NAHB and others said that lending for builders was a top advocacy issue. And then it got a little bit better in 2013, 2014. The tick up is what I'm a little bit concerned about right now. The dashed line is a Federal Reserve Senior Loan Officer survey, and it measures overall commercial real estate lending. We're actually in tightening conditions right now, and I think that is true from what I hear from multifamily builders, that the lending terms are getting tighter than they were a year or 2 years ago. And then the NAHB survey is starting to tick up as well. We're not hearing that necessarily from single family side or land developers yet, but it is something to watch as we go forward, even though interest rates are low. So I created that sort of 3 L's way of thinking about the supply side. The other thing is the big R, which is regulatory burdens. We did a study looking at the cost of for sale housing in terms of the cost of environmental rules, labor rules, zoning. One, they're going up. More and more rules are being pushed out. The costs of that are up about 30% over the last 5 years. And in fact, on the single family side, they can represent about a quarter of a home's final price, with about 2/3 of that impact being attributable to the lot development stage. So that obviously then applies on the multifamily side as well. So you've got input costs rising from the business side as well as local policy decisions. I like to tell people, I'm sort of in a community of chief economists. You got Zillow and Trulia and the realtors, and we get together in panels, and what we do is we argue with each other for sport, basically. That's what we like to do, is disagree with each other. There is one place where we all have sort of united agreement, and that is we have a housing affordability crisis, particularly on the rental side, and if we want to address it, we need to think of beyond simple income distribution elements, which I think is going to be an important part of the campaign and the next administration. We also need to think about in terms of regulatory costs and land use decisions. If we want to increase supply, we've got to increase the amount of land that can be used to be built on. Demand is there. And if you look at markets, I was recently in Portland, they could build apartment buildings much further out than they're doing, but they have very strict land use requirements. So a market like San Francisco, for example, you're going to have rent growth, and you're going to chase away those younger millennials because they simply cannot afford to live there given how land use decisions are made. So these things embed themselves in the system and then help determine the amount of home construction that we have. The other thing is we do measure these regulatory burdens and how they deter or delay construction costs. And from 2011 to 2016, in addition to a 30% increase in cost, we've seen the time period of delay increasing. And of course, time is money, so those delays increase costs and increase demand. All right, so if we put this together, let's take a look then at what residential builders are building and adding to the market. One, a lot more multifamily. So the blue is single family units under construction at any given period of time. The red is multifamily. You can see basically 2000 and 2006, it was roughly about 30% of units under construction at a given moment was multifamily. Today, it's just under 60%. So we've got a lot of multifamily units in the pipeline. The condo share is way down. It's mostly for rent, 90%. And then we look at the types of homes being built. Again, most of it's for rent. That's the blue columns as the growth has occurred. The condo market really hasn't increased. Condo resales are doing okay in cities like New York and Miami, although there's a bit of weakening right now due to the dollar going up. That's reduced the amount of foreign buyers. But the size of multifamily units has gone down from 2006. And this is interesting because it's a flip on what we've seen on the single family side. On the single family side, the median home size of new single family detached units is higher than it was in 2006. There's just a lot less entry level housing being built. So the home right in the middle of distribution is being built for an older, higher income buyer. Got the opposite situation. In some ways, you can sort of say, the question that's posed is, why aren't builders building more entry-level housing? Well, they are. It's entry-level right there in terms of multifamily for rent. And then we've seen growth in terms of the concentration of building in the top markets, and that's a trend that's been in place in 2010, since 2010. All right, so if we put it all together, what do we see in terms of our forecast? One, I threw in remodeling. We actually are kind of on the pessimistic side of the remodeling market. I think Harvard's Joint Center for Housing Studies has like 8% growth in the remodeling market. We have it lower because we see a reduced level of existing home sales volume. But we do see it being positive because we see growth in things like energy efficiency and aging in place remodeling activity taking place going forward. On the single family side, this is the monthly NAHB Wells Fargo Housing Market Index. Currently stands at level 59. It's been in kind of a rough trading range, 58 to 61 since I've taken over as chief economist. Our press folks keep saying, give us something exciting we can talk about. It hasn't really moved around a whole lot, and I tell them, okay, well, I'll hold you to that when it goes down. But builders are feeling cautiously optimistic. Any level above 50 indicates that market conditions are positive rather than poor. So for the single family side, before I get to multifamily, what we've got is basically continuation of trend with a bit of acceleration. I think I said that at the beginning. So for this year, we think 2016, probably about 11% growth. And then picking up as the industry's infrastructure rebuilds. I identified the challenges. They are challenges, but they're ones in which we do see that the labor force is growing. It's just not growing as fast as we would like. So this represents a bit of a reduction in the kinds of forecasts that we put out a few years ago, but it does show growth. I'll skip some of these. This is NAHB's quarterly multifamily production index. It's a confidence measure for multifamily builders. It's still in positive territory. It's the blue line, but you can see it's been kind of tapering down a little bit since the end of 2014. And this is very consistent with what we have for our forecast, which is the growth rates that we saw in 14 and 15 are easing off. We do see negative growth rate in 2016, but at a high level of production. So we think the normal levels of production, basically equivalent to population growth and need to replace older housing, represents about 330,000 new multifamily units a year. So for 2016, 383,000. That's kind of where we are in our forecast. It's a bit of a decline, but well above normal levels of production. And then we have multifamily kind of remaining there above normal levels for the next few years. Again, think back to that graph that I put up of the population demographics in the yellow box. There's just a lot of people that are going to move through the system. So the period in this cycle of really strong growth rates for multifamily is over, but we don't see a big decline. And I would say in terms of forecasts, they're all over the place. We've seen multifamily forecasts that have it going up to 500,000. We've seen ones where people have it declining 15%. I think we're kind of right in the middle, which is healthy levels of production going forward due to that demand. In terms of the distribution of type, still going to be dominated by market rate. The low-income housing tax credit is actually the green components of these columns. Unit counts are a bit down. That's something that, when we think about rental affordability conditions, getting some growth in the low-income housing tax credit would certainly be a positive thing. We do have a rental affordability crisis in this country, and the tax credit program succeeds like none other. So I mentioned, are we building the right kind of housing? I do think building more multifamily right now is what the economy needs. The question is, are we building enough on the affordable side? And so we need to be looking at the bond programs and the tax credit and the ability to just simply do deals in order to get that kind of housing into the marketplace. And then when we look at it regionally, this is return to normal. So basically our baseline level of production that we expect for each state, which states are doing well. Roughly the states in green are doing well, the states in red are lagging for multifamily production. This is not single family, just multifamily. It's kind of consistent with what we expect in terms of where population growth is occurring, where you see pickups in economic activity. Again, Illinois sort of lagging. That kills me as sort of a native Ohioan Big Ten country, but those are the areas where you don't see as much growth as, say, the South and the West. And with that, I don't think sometimes PowerPoint can be a death march, so I did try to keep it to 35 minutes. So ionhousing.org, by the way, is our economics blog. You can register for it by email. We tend to do one post a day. Housingeconomics.com is our subscription service. It is fee-based. If you're on Twitter, there's my Twitter address. But I did want to save time if people had questions on kind of anything or just a discussion going back to the macroeconomic conditions or just housing questions in general. Yeah.
I saw an article recently that shows that multifamily housing targeted towards millennials are at rent levels that are too high for millennials to afford. So is that affecting that chart where it shows more millennials are living at home?
Yeah, I think that is part of the equation. When we look at the census data, that's exactly what we see. It's also contributing to what is the primary challenge of home ownership. I mean, we do think that most millennials, 2/3 of them, will become homeowners at some point. At least they want to be. When rents are high and student loans are, the typical student loan burden from someone graduating college has gone from like $73,000 to about $30,000 for those millennials. So rising rents, rising loan burdens means that it's harder and harder to accumulate that down payment. And it's a bit of a shame. When you think about it, it's sort of the historically low interest rates. If you can't accumulate the down payment, you can't participate. But yeah, when we think about our forecast, the high rents actually help on the supply side, but there's certainly a social issue going forward. Yeah.
You didn't mention anything about foreign capital coming into the United States, especially into the housing market, as there just doesn't seem to be a lot of places in other parts of the world to invest. And they're actually, it looks to me, in the housing market, that some are, they're not even interested in renting it.
They just want to own it.
Just to shelter the money and hope for increase in value and take that as their profit.
Which market?
Central Texas.
Central. Yeah, over the last few years, the global economy story, at least on the finance side, has been the search for yield. Right? You have global savings glut. I like to say it's the last echo of World War II. You have just a demographic bulge, lots of savings looking for relatively risk-free places where you can get yield. And U.S. real estate has been an attractive area for that. So you didn't see a lot of capital flowing necessarily into the new construction segment. We used to hear stories about this in California, Chinese buyers, for example, just buying new construction and helping builders along. There were some builders who saw that. But I think a lot of it is purchases of existing real estate, commercial real estate. And that's, of course, going to diminish as the value of the dollar has gone up. And the one thing that we sort of see in this kind of market is that anytime there's global political issue or some kind of crisis, the ultimate flight to quality is U.S. Treasury bonds. And the result of that is it pushes the dollar up. It keeps U.S. interest rates low, which helps on the business side and helps keep U.S. mortgage interest rates low. But that push up in the dollar then helps to diminish some of that effect. And so I think we're starting to see in New York and Miami, again, like in the condo market, a bit of weakening among the foreign buyer class. But yeah, U.S. real estate as a hedge, as a global investment strategy, has certainly been a trend over the last few years. We saw that in the 80s too. I mean, it's partly cyclical. But it is sort of funny when a lot of people are sort of negative on the prospects of the country, and then you go look at global finance markets, people vote with their dollars. And I say dollars, right? That's, it's a vote by the global elite that the United States is the ultimate safe investment. And we have advantages that other countries don't. Relatively youthful population, the top university system. It is a great place to invest. Competent government, you may disagree with the politics, but it works most of the time. Needs a little help from now and then. But it does represent a good investment. Yeah.
How much of your single family data is, or how do you go after data for single family markets that include like foreclosures, bankruptcy, fix and flips that are actually on a more wholesale level where it never really reaches conventional financing? In other words, you don't have a lot of data on it. It's done with cash investors and people like that, because there's a huge amount of inventory that hits that never even shows up. And that's a huge trend, like all over the country now. And I'm curious with your data, how much of that is actually in there or not?
Not, well, it's going where I think you're suggesting, which is not as much as we would like. To measure that kind of thing, one of the things that we use is the American Community Survey, and we use the vacancy data in that. Now, it comes out with a data lag. Fortunately, when we're forecasting, we're mostly forecasting building, right, the increase to the stock. So we're mostly concerned about those demographics and things like that. If you're trying to forecast the volume of existing home sales, you have to have that information in a more real-time fashion. The vacancy survey, it's good. You can see things like bank-owned properties, and then you can get the idea of flips and things like that. We actually use the vacancy survey data to look at the distribution of second home ownership, which was an important policy issue in various rounds of mortgage interest deduction discussion, looking at second home ownership. And I think there was kind of this myth that believed that second homes were just concentrated in the coasts. And when we looked at the data as a share of the housing stock, second home ownership was really concentrated in places like Michigan and Utah and other places. But yeah, the bank-owned stuff, it's a little bit hard to measure, but that's what we use. Yeah.
You were talking about the home ownership and millennials. What do you think of the fad or the trend around tiny homes?
I think it's a fad. Yeah. You know, the time, you know, so my wife and I will watch Home and Garden television. You'll see some show on tiny homes, and I mean, I don't know a lot about building codes. I sit near the guys in our group at NHB who do building codes, but I've overheard enough of them that when my wife sits there and watches, she says, "Can you really build something like that? I mean, it looks like it doesn't have resiliency and energy efficiency and all the other sort of ever-tightening requirements that we put on new construction." And my answer is, well, no. You know, so I think it's a fad. You don't see a lot of it in the data. It makes for great stories. You get questions from journalists about it. Ultimately, you look at the data, it's pretty consistent what people occupy in terms of space. It's about 800 square foot per person. Now, it's a little different in big metro markets. I'm in a 1,200 square foot townhouse with 4 people, two kids, 2 adults. But you know, nationwide, it's about 800 square feet. So typically, when you look at the apartment markets, you know, 1,600 square feet per person for millennials. And when they talk about buying, the type of home that they're looking at is not 3,000 square feet. Plus, it's about 2,400 square feet. Why? A couple plus, you know, their first kid. So that's sort of entry level. So I tend to think that's a trend. It's an interesting one. I watch those shows, but I don't see it as something that's fundamentally going to change home construction and building. Yeah.
If on your 4th slide you showed this economic recovery or growth period being the 4th largest and longest in history, but would it be fair to say that it's still very lackluster at best? And even if you took out the oil states of North Dakota, Texas, and the boom they suffered, you probably would have had a longer recession.
That's right. In some ways, you can almost sort of say, well, the recession that we might have had already just happened, which is the decline in those oil prices. You did have big declines in business investment. And I think you're hitting the key point, which is what makes it difficult to forecast the macroeconomy, which is the economy is functioning under potential, particularly when we think about home building. Home building's share of the economy, typically about 5 to 6% of GDP. Right now, it's about 3 to 4% of GDP. And you have other sectors of the economy that are functioning under potential. So the result is when you do get a supply-side shock that ordinarily would have created a recession like we saw in 2001 or the early 90s, you get a little bit of weakening, kind of like what we're seeing here. But then those other segments of the economy that are currently functioning with slack sort of pick up the benefits as capital moves around and financing becomes available.
Can you forecast anything about the width and depth of the next recession based on that?
I've done that.
That's too much to infer that it won't be as long or as deep.
Well, we should talk about my next NAHB exec board presentation. Yeah, so what we did was we looked at, what would the next recession look like in terms of its impact on housing. And what the numbers tell me right now, and this may sound like sort of apologetics, but is that actually home building and housing is a bright spot in the economy right now, an economy that does seem to be slackening off. And because of the under potential, Typically, every recession, you look for that segment of the economy that helps push the economy going forward. It would be home building and housing. Lower interest rates, underperformance, really positive demographics. So if we do have a recession over, let's say year 3 or year 4 of the next presidential term, whether we get tax cuts or spending, year 1 and 2 of a new president tend to have a political business cycle effect where growth goes up. But then you get a bit of a hangover in year 3 or 4. What are the sectors that can provide that underpinning, that provide growth? It would be things like public infrastructure investment and residential construction. That's where you get growth right now. Single family construction, by the end of 2018, we will still only be to about 80% of normal level of production. And multifamily production will still be high. So if you're looking for that area where you'll get juice to GDP, it's residential construction. Yeah, Mark.
So we started to get used to, in our housing credit industry, of paying investors paying more than $1 for $1 of credit. But what is mystifying me is how some governments are able to offer bonds at negative interest rates. Is that something, I read an article about it, and I still don't understand how it makes sense.
Yeah, there was a great Wall Street Journal article maybe a week and a half ago, or over the 4th of July week, if you're interested in this, sort of looking at sovereign bond yields that offer negative yields. And I think it represented, but don't quote me on it, but about 10% of government bonds globally right now. This is that search for yield. What you're seeing is a lot of capital. It's demographic based, savings of baby boomers, globally, I was going to say nationwide, globally, looking for places to make investments. And so that is a real challenge for monetary policymakers, because again, they want to ramp up interest rates to something more normal. The Fed funds rate, getting up to 3-4%. So that the next recession comes, they can cut rates. Right now, if a recession happened and you're a monetary policymaker, you would have to go back to quantitative easing. So the question is that a long-term trend that's here with us to stay? I think yes, for the next 10 to 15 years. Again, I'll go back to Japan. Japan may have been sort of our future playing out in the 90s, which is Japan has been trying to create inflation, get out of a deflationary spiral. And he said if you had to choose between high inflation and really bad deflation, in some ways deflation is worse because it encourages all kinds of bad investment decisions and things like that. And they have been unable to create inflation in their economy, despite fiscal policy attempts, monetary policy attempts. Why? It's because of the demographics. Economists can create policies, probably half of them won't work, but you can't beat City Hall, you can't beat the demographics in some of these monetary policies. So I think negative yields are here to stay, and that will then have an impact on U.S. financial markets. We tend to think of negative yield, or not negative yields, but low interest rates as being a good thing for real estate. In some ways, it can actually have a deterrence effect. If you're not, from the finance side, if you're not getting the profits that you would expect, then you're going to get a reduced supply side response offering those financial products. So it's about trying to get back to a normal marketplace, but when you've got all that equity out there looking for some place to park, it's very difficult to do. Yeah.
You mentioned that I think in 2018 will still be about 80% normal on the single family.
Right.
But you also mentioned that millennials, we have this huge debt load from undergraduate and graduate education, and many of us are staying at home. Why are you confident that just won't be the new normal? That they can afford, or we can afford to buy those homes in 5-10 years?
Yeah, so if you look at the preference data, particularly, so we do a prospective home buyer survey every year, and so we oversampled millennials the last time we did it. Most wanted, 2/3 wanted to own, they wanted single family, and they wanted to live in the suburbs. It wasn't that different than what we saw before. So we could be wrong, but we think those underlying preferences, along with things like they want to get married, most want to have kids, most, are going to drive the market. So we can't confuse the lack of means that accumulated down payment with a change in preferences. And over the last 3 or 4 years, we've seen all these stories about millennials wanting to rent in large, like downtown DC, downtown New York, and that's what everybody wants to do. Well, there's always been a segment of the population that wants to do that. Is it a little bit larger now? Yes. Does the type of single-family single-family homes that millennials want to eventually move in look a little bit different than what the Gen Xers and baby boomers? I think so. If you look at the preference data, they're more sensitive to walkability. They want walkability. They want higher density. That's something I talked about, regulatory burdens and land use decisions. We need to enable density where market conditions would suggest we need to build that. An example of this, the complaint against the building industry is not enough entry-level homes on this for sale side. But you look at townhouse construction, single-family attached, it's up 30% year over year. In other words, the townhouse construction market's growing faster than the overall single-family construction market. Yeah, I'm in a townhouse. So there you see, I think, the result of, there's always going to be a place for the single-family suburban development. But at the margins, you're seeing additional demand for density. And it has a lot to do with sensitivity to commuting costs, co-parenting. If mom and dad are both spending equal time with the kids, you're probably more likely to want to live somewhere where you can drive home a little bit faster. So there's some sociological underpinnings as well. So we think the long-term drivers are there. They anchor where traditional suburban development is going to take place, but a little bit of a change. I probably have time.
Within the shortage of labor across the construction industry, how much of that is segmented more towards electricians, plumbers, skilled labor versus carpentry? And then is that more or less an education policy issue or an immigration policy issue to help solve that problem?
Yeah, there's a slide, I didn't include it, I kind of wish I had now. When we look at the wage growth by occupation class, you see the biggest gains and biggest shortages in the highest skilled positions. So for example, the solar panel installers, wage growth was up 30% between 2012 and 2014. The professions that are in the greatest demand, the shortage, and you see some of the growth, carpentry, electricians, plumbers, framers, the sort of skilled positions. Down at the labor class, which is basically, it doesn't require a lot of sort of prior construction knowledge, not as much. So the answer to the question of, is it an immigration, is it an education thing? A little bit of all the above, but I would probably weight more toward the education side. This country probably needs to think more about the community college system. Does everyone need a 4-year degree? The story I like to tell, I know people in this room have heard me say it before, but I have a younger brother who's a math professor and a cousin who's a plumber. And the cousin that's the plumber makes 3 times what my younger brother who's a math professor makes. So, who's better with numbers, basically? The plumber. And that's true. And so, the whole notion is sort of the American dream, get married, have kids, buy a house. We've sort of appended onto that, get a 4-year degree. That's good, and particularly in a global workplace where this economy functions less on manufacturing, more on services and high-skilled position. But you don't need to get those high skills necessarily by getting a liberal arts college degree. And my wife's a college professor, but she teaches at a community college in the DC area. And she used to teach at the University of Maryland, and she actually kind of enjoys the community college experience a little bit more. I think a country rededicating itself to a little bit more focus on vocational skills is a good thing for the medium term. Any other questions? Great, thank you for coming out for a very early session. I appreciate it.